Hello, and thank you for joining us today. I'm Taylor Combeluzier, a mining analyst at RegFab Securities. Today's webinar features Talisker Resources, which is developing a portfolio of high-grade assets in British Columbia. It's currently focused on its flagship Bralorne Gold Complex, which covers a 33-kilometer district-scale gold belt. The Mustang Mine is currently in production with its first gold sales this past August, and ramp-up continuing. Secondary assets include the resource stage Ladner Gold Project and the discovery stage Golden Hornet Project. Today I have with me on the webinar Terry Harbert, who's the Chief Executive Officer and Director of Talisker. The format of today's webinar will be comprised of two parts. In the first part, Terry will provide an update on Talisker and what investors have to look forward to going into 2026. In the second part, we'll take your questions live during a Q&A session. So please send us your questions via the chat, and we'll get to as many as we can. I'll note that you can type in your questions at any point. To start, I'll handle the disclosures, and then I'll turn it over to Terry. For Talisker Resources, there may be some forward-looking statements made on this call. I would direct listeners to the cautionary note on the page website. For Red Cloud Securities Inc., I would highlight that this webinar is for information purposes only and should not be considered as a solicitation to purchase or sell securities or recommendation to buy or sell securities. We note that this call does not take into account the particular situation or needs of individual investors. Participants should rely on their own investigations and seek their own professional advice before investment. Please see our most recent research located on our website for Talisker-specific disclosures. So with that out of the way, I'll turn it over to Terry to update you on Talisker and what you have to look forward to.
Taylor, thanks very much for the introduction, and welcome everybody. Appreciate you coming along to hear the story of Talisker Resources, and in particular our flagship project, the Bralorne Gold Project. It's a high-grade underground gold mine in production, and this is one of our production faces there at surface, actively mining and extracting and selling gold right now. Here at Talisker Resources, we've got a very strong and well-developed vision for how we want to grow the company. Our vision is to become a multi-asset gold producer, so multi-mine producer, developing district-scale gold belts that ultimately leads to the production of more than 200,000 ounces of gold annually. We're well on the way here with our first mine going into production about midway through this year, 2025. And we'll be looking to bring our second mine online, the Olympus mine, at the end of 2028, 2029. So a very strong vision for the company going forward. Our mission is to achieve this vision within the next 5 years. Part of our strategy has been focused on a low capex, low dilution, rapid startup. To initiate this strategy, we've been looking at utilizing existing facilities where we can sell our ore or process our ore and negate having to use excessive capital to build our own mill in the early stages of our project ramp up. Supporting this strategy is really where we're located in South Central British Columbia, in what is really the heart of mining in British Columbia, with many of the largest producing mines located within highway truckable distance from our project. Some of these you may know well. Highland Valley, which is Canada's largest copper mine owned by Teck Resources. Hudbay's owned Copper Mountain, 65,000 tonne a day producer. And topical at the moment, New Afton's New Gold, currently Canada's largest underground block cave copper gold mine. Further to the north, we have Mount Polly, Gibraltar, and the new Caribou project owned by a Cisco development just coming online. So a lot of existing facilities, a very infrastructure-rich area. Initially, we signed a ore purchase agreement with New Afton. We're currently trucking and milling our material at Craigmont Toll Mill, owned by Nicola Mines. And as of January next year, we'll be direct shipping our material to sell that to Ocean Partners, a global metal trading group. And our agreement is for up to 1,500 tons a day of production facilities. We're able to truck and rail down to the Vancouver port very easily from the Bralorne Gold Project, located directly north of Vancouver, about 3.5-4 hours drive in the summertime. Located in the valley just north of Bralorne is extensive hydroelectric generation facilities owned by BC Hydro. And approximately 15% of British Columbia's electricity comes out of that valley that we're located in. So we're fortunate to be located right on grid power. Also, existing access to a very skilled labour force, not just out of Vancouver, but also out of Kamloops and Kelowna, which are major mining hubs in the region. Finally, and most importantly, in Canada is a favourable operating climate. We're located in the rain shadow, or snow shadow, if you like, of the coastal range where Whistler is located. So relatively limited snowfall, about 2 to 3 feet per year, which has given us the ability over the last 5 years to operate all year round. So really a fantastic place to be located, and something that's allowed us to get our project up into production very quickly and with limited capital requirement. Taking a step back here and having a look at our share structure and market capitalization. Our market capitalization currently about 250 million Canadian. Current shares outstanding a bit over 170 million, about 200 million fully diluted. We currently have 33 million in cash and an additional 35 million in a revolving credit facility that we haven't drawn. So just under 70 million available capital for producing our mine. Our shareholder breakdown, we're broken between about 50% retail and a bit under 50% institutional. And the institutional is led by some very strong names. Franklin Templeton at 9.9, Arbiter Partners also at 9.9, and their principals at about 4 or 5%. The Phoenix Gold Fund out of Singapore at another 9.9%, and some other stronger names below 9.9, such as Equinox Partners, Merck, the Gold 2000 and Conwave Group, and US Global. So a very strong institutional shareholder base. Out of the insiders, majority held here by myself, the CFO, and our chairman. So very strong support for the company going forward by the insiders. Our share price here over 1 year, we've gone from a low here around 30 cents to a 52-week high of 86, and we're currently trading at about $1.45. You'll notice here that there has been a 300% increase in our share price, and this was triggered by us transitioning into production. We don't believe that the growth is going to stop there. Over the next 3 years, we've got a very strong growth in our production rate and our gold production as we ramp up the Bralorne Gold Project. We believe that we're well positioned for growth over the next 5 years. And I'd like to point out what we've been able to achieve over the previous 5 years since acquiring the asset. About 165,000 meters worth of diamond drilling that supported our mineral resource estimate of 1.66 million ounces. We've completed an additional 20,000 meters since completing our resource statement. So about 185,000 meters of diamond drilling. Our first resource statement, we've completed our mine design and permit amendments, completed our portal, and 600 meters worth of decline development. We secured our key financing and finalized our First Nation partnership and production agreements, all in a 5-year period, while most other junior companies are still poking holes in things. This year has been a seminal year for Talisker Resources. We've finalised multiple milling agreements, led by our 1,500 tonne per day agreement with Ocean Partners. Finalised our trucking agreements, which is a joint venture with our First Nations. Completed all of our access and lateral development and initiated production, all within 2025. And most importantly, achieved our first gold sales and revenue, which we're currently achieving on a monthly basis. What I want to make clear here is that Talisker Resources is a company that delivers on its promises. And we've achieved all of our milestones within the times that we've reported to market over the last 5 years. And we're confident that the next 5 years will also be able to achieve these milestones. 2026 is a very exciting year for Talisker Resources. We're looking at a significant resource update and publication of our PEA. We're expecting to add somewhere between 800,000 to 1 million ounces to our current resource to give us a runway of 2.5 to 3 million ounces for our mine plan. We'll be ramping the Mustang Mine, our first mine, up to 500 tonnes per day production. We've completed this year very successful studies in laser-based ore sorting, being able to separate quartz veins from our host rock. We're in the process of installing that system, and we expect that system to be fully operational by third quarter of next year. We're working on the scoping of the development of our second mine, the Olympus mine. It'll be about 2.5 kilometers from where we're currently mining at Mustang. We're also looking at right-sizing and finalising our own on-site mill. So we're using off-site milling, toll milling and ore sales to get revenue, to get cash flow, and then look to build a cash pool for when we need to build our own mill. Over the next few years, we'll be finalising our mine and mill design for Olympus and our own mill and submitting these additional permit amendments, looking to bring our second mine and mill online by the end of 2028 and 2029. By then, we expect to have ramped up our first mine to 1,000 tonnes per day. And then by 2029, we'll be commissioning our own mill, bringing our second mine online and ramping it up to 1,000 tonnes per day as well. So a very exciting timeline over the next 5 years. Let's look at what we've achieved so far this year, having going into production in June of this year. Lateral development completed on 6 levels: the 1060, 1075, 1090, 1105 and 1120. Completed stoping between the 1060 and 1075 and currently stoping between 1075 and 1090. So a very successful start to mining. We're producing at the moment 2 products that we're selling, again, to Ocean Partners, a gravity concentrate that has gold values between 40 and 50% of gold. We're also producing, as you can see in the pictures on the bottom right-hand corner, a sulfide concentrate. And the sulfide concentrate generally contains between 70 and 100 grams per ton of gold. So a very successful transition to mining, something that only about 1 in 1,000 mining companies is able to successfully achieve. We're looking at fast-tracking our development plan. Mustang, where we're currently mining, is on the left-hand side of this diagram. We're developing across to Bralorne West, which is a new area, a new underground area that we'll extract through the same portal as at Mustang. In this area, we have 5 high-grade ore bodies. We'll be developing 2 spiral ramps to access this material and support our high volume of production. So we'll be developing about between 16 and 20 working faces. And this is currently planned to be extracted across 30 levels. So a very robust plan as we continue with our ramp up in 2026, 2027, and on to 2028. We're looking here at our quarterly production tonnage. We're just updating our mine plan with a view to bring this production profile forward so we can have increased production in 2027 and 2028 to capitalize on the all-time high gold price that we're currently seeing. Next year, we're looking at a very exciting update to our mineral resource. We're looking here at a long section from left to right is about 5.5 kilometers. So a very large footprint where we're operating. Our resource is in the golden color that you can see. And Mustang on the left-hand side where we're currently working is about 2.5 kilometers from where we expect to put in our second portal and build our second mine, the Olympus mine. Bralorne is a low-risk mining project because it's a historic producer. You can see in the grey, historic mining. Bralorne was mined to about 2 kilometres depth, was in production for 40 years and produced a total of 4.2 million ounces at 17.7 grams per tonne. We're very fortunate to be bringing Bralorne back into production, and even though it hasn't been in commercial production for more than 50 years, it still holds a position as the highest grade, largest, longest producing gold mine in Western Canada. And our view is that there's in excess of more than what's already been mined directly underneath and in between the old mines. So we're not remnant mining. What we're doing is mining in the ownership gaps between the historic mines. Our resource coming in, we're looking at validating a lot of historic drift assay data. So these are levels that have been developed every 50 meters, sampled every 2.5 meters. So very high quality data, level plans with mapping. You can see some very high grades here. The reds are above 15 grams per tonne. The purple's above 20 grams per tonne. So we're working with our QP to bring this into our current resource base, and we expect at the moment between 800,000 and 1 million ounces to be added to our existing high-grade resource. All that we've spoken so far about Bralorne sits in the middle of our regional land package. One of the first things we did when we acquired the asset was to consolidate the entire district. We conducted 14 land deals and were able to secure about 15,000 hectares worth of mineral claims across a 33-kilometre trend. All of the dots that you can see are historic vein mines, about 47 of them along this 33-kilometre trend outside of where we're currently in production. Some of these have existing resources. The Congress mine, a resource of 186,000 ounces at 9.1 grams per tonne. Only ever drilled to 200 meters from the surface. And we know that these veins can continue to 2 kilometers and beyond because that's the depths they've already been mined to. Closer to Bralorne, we've tested some of these historic areas. The BRX, our first drill hole there, received nearly an 11-ounce intercept. Many of these other areas have had limited modern exploration over the last 50 years. So we'll be looking to continue expanding and developing satellite deposits outside of the main gold camp along this district scale trend. At Congress, we expect to be able to drill to between 500,000 and 1 million ounces as a satellite deposit. And once we've implemented our own mill, we'll be inverting our remote milling strategy, building up a cash pool with remote milling to finance our own mill organically. and finally building a hub and spoke scenario where we develop satellite deposits along this 33-kilometre trend and truck that material into a central processing facility. So we believe we're developing a very compelling value proposition. We're strongly capitalised here, fully funded, and we are in production right now. A strong cash base with access to almost $70 million. It was low capex and a rapid startup because of the strategy we looked at with off-site processing that helped us to avoid going through the Lassonde curve, being able to go straight from early development into production. The basis is on a strong high-grade resource, a top 5 in grade in Canada. We're looking at adding by first quarter next year another 800,000 to 1 million ounces to this resource and to our mine plan. However, we believe that directly underneath where we're currently mining, there's significant upside for in excess of 5 million ounces that's supported by historic drift assays and level plan mapping. And finally, a great production profile. Within the next 2 to 3 years, ramping up to 100,000 ounce per year production at the Mustang Mine, and then looking at doubling this from 2029 onwards as we bring our second mine, the Olympus mine, online, and then look to build our third mine, which at this stage we expect to be the Congress mine, located about 10 kilometres to the north of our current facilities. And that's Talisker Resources. I'll pass it back to you, Taylor, and any questions that might have come in.
Perfect. Thank you very much, Terry. So now we'll turn to the Q&A portion of the webinar. Just a reminder to everybody on the line, you can type your questions into the chat box at any point. That said, we do have a question in here. Can you explain the reasons behind the gram-ton reconciliation in the couple months of production? Is this expected to rise when shipping to ocean partners?
Yes, absolutely. So our early production and processing was mostly with what we call development ore. And development ore is where you develop along the veins. Well, we can have a quick look at it to explain it a bit better. So the gold areas at each levels are what we call development ore, and that's developed at about 3 or 3.5 meters of width. And that's to allow the vehicles that need to extract the stopes, which are in blue, to be able to extract ore and take it out. So it has an extra dilution factor. So the veins are on average about 1 meter and 10 centimeters wide. So when we're mining these veins in development at 3 meters, we have a 1:2 dilution factor. In the stopes, which are in the blue areas, and that's between each of the development levels, we're generally mining between 1.5 and 1.8 meters. So our dilution factors are much lower, and therefore our grade is much higher. So most of the initial ore is from these development fronts, and now we actually transitioned this month into predominantly stope ore. And what we'll be trucking to ocean partners will be stoped ore. And after second quarter, we'll be looking at ore sorted. So ore sorted stoped ore. So that'll have a physical concentration. So we'll be removing as much of that dilutive material or the wall rock as we can. So it's likely to increase the grade profile by 80 to 100%.
Perfect. Yeah, the ore sorting looks like a game changer once that gets implemented and can make a big impact. Next question here. I'll just read it out. When will October's production be reported? You previously provided monthly production updates. Is this the plan going forward?
No, we originally just did the first couple of months because it was our initial production. Now, in line with the Securities Commission, we've fallen into a quarterly reporting cycle, and that's what we'll be reporting going forward.
Perfect. Okay. Just another question here in terms of the Olympus mine and bringing that into production. Do you have an idea on the capex required? I don't know if you've made comments on that previously or not.
No, at this stage, we're in the planning phases of that. The development's not expected to be particularly high. The access we'll be developing will be quite close to surface. It's probably only a couple of 100 meters of development, and we'll be structuring our development so much of the access will be in vein development, basically, so we can get to a point where we can generate cash flow very quickly by developing into those veins. At this stage, we're probably looking at around about a 20 million estimate. That'll be relative to road construction and decline development. We're expecting at this stage that we'd fund all of that through cash flow from Mustang.
Okay. And then just maybe a clarification here on throughputs. Mustang idea is to get up to 500 tons per day, then 750 with Bralorne West. And then once Olympus comes on, does that gets you over 1,000 tons per day? Is that?
By the time we're in full production at Bralorne West, the combined Bralorne West and Mustang will be between 750 to 1,000 tons per day, depending on the schedule. And then we're looking at a parallel production at Olympus. So we'll basically ramp that up over a couple of years to 750 to 1,000 tons per day.
Okay. Just put out another call for any questions from the audience. Okay, and then we have another one here. Maybe just some comments about the switch from the milling that is wrapping up at Nikola Mining and now that Ocean Partners agreement. I just have a question, wondering about the context behind that.
Yes, well, look, it's all the change is all relative to growth capacity. And I don't know if the listeners are aware that the permitted capacity at Nikola was 200 tons per day, which certainly was suitable for us here in the first year of production. However, we've got a very clear growth profile, and we aren't able to, wouldn't have been able to achieve that if we had have remained with Nikola. So we've been consistently looking for other milling partners, either all purchase, mill lease agreements, or other toll milling scenarios. And as we've been selling concentrate with Ocean Partners, we opened up the discussion there about direct shipping. Really, their capacity to process ore is almost unlimited. The initial agreement we have is up to 1,500 tons per day, which fits very well within the next 5 years for us, and certainly gives us very good revenues and cash flows until we build our own mill. So that's really what the transition was to be able to have support to increase our capacity up to what our current mine plan is. And a bit beyond that, if we face any delays with permitting, with equipment procurement, then it has no impact on us. We can just keep shipping it to Ocean Partners.
Okay, perfect. With the I guess the mine plan, we have a question here wondering, what kind of grades would you be looking at from the 750 to 1,000 tons per day? I don't know if you'll be planning to put out guidance going forward, and any comments around that would be helpful.
Yes, well, I can't comment on ounces and things until we have an economic study out, and we're well underway in the preparation of that, and we expect that end of Q1 or early Q2, which will be our first economic study coming out. I can give you a range of grades, what we expect, and that's a pre and a post ore sorted amount. So pre ore sorting, we're expecting anywhere between 6 and 12 grams per ton, and with ore sorting, we're expecting that to increase by 80 to 100%. So looking at somewhere between 16 and 22 grams per ton material.
Perfect. Okay.
Tyler, just to confirm, we're restricted with guidance until we put out the economic study. So we're well working on that. We understand that people would like to see what our guidance is going to look like. So we'll certainly have that ready to go end of Q1, early Q2 next year.
Okay, excellent. Another question here, just wondering about risk factors in regards to getting ore sorting up and running. What makes you nervous?
Well, I can work through the components. Always the main thing that makes you nervous about any construction facilities at a mine site is procurement and procurement timelines. We're in the production queue for the ore sorter now, and that's been guaranteed from TOMRA that should arrive May or June next year. So that fills well with our timeline. All of the other providers, we're finalising purchase orders and transactions for those materials now. It's fairly stock standard equipment. It's a sprung structure from tons of groups that do those here in Canada. It's a fairly generic supported cement pad that'll be down. We've got primary and a secondary crushers that's coming from from Terex, so a big crusher production, and the conveyors, wash plant. So at this stage, I'm not particularly nervous. I think we have an extended plan that has contingency for the timelines. So we've just got to work through the process. But many of these things are developed offshore and then brought on, either in Europe or in the US. I think we've factored in enough time fat, if you like, in the process to bring this in on time and online. Aside from that, I guess it's always the weather. We are operating in the winter in BC, so we're trying to get a lot of things done. Main thing is we want to get earthworks, sprung structure in, heating in, so a lot of the implementation can be conducted undercover. So I think that's a clever way from our operational team to make sure that we can hit those targets.
Perfect. The next question here, when do you estimate that you would use some cash flow to pay a dividend to shareholders?
I think at this stage, particularly over the next 3 to 4 years, we're better off putting our capital into growth, really into building that second mine so we can effectively double our production, and then looking at building our own mill. From then on, it'd be a trade-off between bringing a third mine online. However, if the gold price changes or the third mine for whatever reason doesn't look economic, grade's too low or too much development, then we'd certainly have a cash pool, and we could have a look at transitioning to a dividend or a hybrid dividend structure where we maintain a pool of capital for growth, and excess capital can be dividended back to shareholders.
Right. And then another question here, is the current permit throughput of 175 tons per day annualized reset at May 2026, being 12 months after your first production?
No, it's on a calendar basis. So that'll be reset at the end of the year here. and we have an updated amendment for 500 tonnes per day. At this stage, we expect to receive that by early third quarter next year, and that sort of combines with when we bring the ore sorter online as well. So that fits in with our current ramp-up plan.
Okay, perfect. I don't see any other questions here. Maybe I'll just give the audience a minute if they've got any last-minute questions. But maybe in the interim, Terry, if you have any final thoughts for investors, if you want to leave with them, I'll give you the floor to make that pitch while we wait for any final questions.
Yeah, sure, Taylor. Look, I think the main message to get across here is delivery of what we promised. We've taken a fast track approach and also a cash constrained approach. And we really believe that that's the right path and how a lot of mines should be put into production, looking at how you can innovate, how you can use existing facilities and reduce that cash burn and reduce that dilution, get into cash flow very quickly and grow it organically. This is a method that most other industries in the world use. For mining, we don't often do it. We like to just keep raising money and grow things with dilutive capital. What we're attempting here is to reduce that amount of dilution that we need up front. We believe we've got a very good growth profile here going forward, but we like to take a conservative approach. Really, the two things or three things that cause a lot of challenges and a lot of failures are a lack of working capital, lack of development, and lack of drilling out front. So there are three things that we focus on addressing. So we've got a very robust pathway, and it mightn't be the fastest pathway that we promote, but we think it's a solid pathway. And there is a lot of things that can go wrong in junior mining, and the more we can mitigate those, the better we can build a robust business as we grow going forward.
Perfect. Have a question, just wondering about if you have a goal for when you're going to be cash flow positive.
Yeah, look, our goal is throughout the course of next year, the second half of next year. We're very close to that now, as everyone would have seen in our financials. I think we'd spent in this first quarter 6.2 and made just under 5.8. We are in a development intensive part, so we don't expect to be cash flow positive immediately because we've got to do the development. So we've got to set the scene for our ramp up, and that is getting that development out of the way. So the first half of next year will be development heavy. So we don't expect to be cash flow positive there, but certainly coming into the second half, and particularly in the final quarter, we expect to be extensively cash flow positive.
Okay, and then another question here. I'm not sure I understand it, but I'll read it out. Transportation saved due to road, rail, and ships. So I'm wondering if you're just wondering about transportation costs.
So the expectation is that we probably won't have any savings with the transition to Ocean Partners. Where we make additional capital is that it's on an ore purchase. So we're paid for total contained gold, not recovered gold, and also our payables significantly higher than our previous agreement. So that's where we make the benefits. Really, where the savings come in transport is bulk. So being able to increase to an increased production rate and being able to truck instead of looking at individual lots, we're doing between 5,000 and 10,000 tons in lots. So that's where the savings come in, transitioning into a bulk movement scenario.
Okay, excellent. I think that wraps it up for questions. I don't see any more here, so I think we'll end things here. I would like to thank Terry from Talisker for taking the time to host the webinar today with Red Cloud Securities. And thank you to everybody on the line for tuning in with us.